exit early. I'm a big fan of exiting early. When I first started investing, I didn't. I hung on that to the end of it, got as much as I could, which also then eventually turned into somewhat long losses. So I'm a big fan of exiting early now. We talked about it. If that trade we looked at here on CSX went up, I said I'd close it out. It only went sideways for a while, I'd close it out. I almost always exit early. I very, very rarely ever go to the end. Very rarely. The reason for that because you have so much that could go against you for the little teeny bit of profit you could make off of that. So always exit early. Whenever you have a profit, exit early. Take it and run. Know your exits before you get into a trade. What am I going to do if it goes up? What will I do if it goes down? What will I do if it goes sideways? Before you get into a trade, know what you're going to do. And then once you're in that trade, now you're in it, so you know what to do if it goes up, down, or sideways. If it does go sideways for a while, and you said, I'm going to close out one half of it, you're still going to trade now, correct? But it's a different type of trade. So now you have to know before you close out one half of your trade, what will I do if I close out half of it if the stock now goes up, down, or sideways? So you're always just rolling back into the same thought process. When you enter a trade, what if I do goes up, down, or sideways? If I close out half of the trade, what will I do now if that stock goes up, down, or sideways? If you change it and go back into a different type of spread, what will I do now if it goes up, down, or sideways? What will I do? Let's take that last trade, CSX, as an example. CSX, and we said, what if it pulled back to 40 and then just stopped, right? Yes? Okay, so what if it pulled back to 40 and stopped, and then it started going back up to about 41? And we said, if it stops and starts to bounce, we said we would do what? Just trade by selling the
42 puts.
Okay, well, you sell the 42 puts. Now you're in what kind of you're in a spread, right? Okay. Well, what if I was back in that spread and I sold the 42 puts and I bought the 40 puts, and we sold the 42, bought the 41, so that's CSX spread, correct? So what now if you're back into that spread and now you went, what kind of spread was it? What if now it starts to bounce up just a little, not very much, if you now maybe sold the 45, 46 bear call spread, brought another 15 cents per share, not about 15 cents per share. Remember, 45 was what? Resistant. So now you sell the 40, so it starts to bounce up a little bit. It's about, so you sell the 42 puts, you're in a bull put spread. Does it cost you anything extra to take your bull put spread into a bear call spread as well? What's that called? Condor. Now I can do a whole other spread for free and get an extra 15 cents. Now my cost basis goes from 41.90 down to, I'm sorry, from 41.10 down to 40.95. Wow. Doesn't cost me anything extra aside from commission if I just lower my cost basis for free. Wow. So then I went from one spread to a condor. Now I have to understand if I go into a condor, what am I going to do if it goes up, down, or sideways? Yes? There's a whole other part of the trade. Wow. Look at all these possibilities we could use if it doesn't work out for us. As long as you keep selling time, you keep getting paid cash. If you keep getting paid cash, you keep lowering your cost basis. What could you keep doing?
Keep trading.
Selling time, keep trading, absolutely. There's a lot of different rules for it, absolutely. Okay. What do I do if it goes up? Adjust the trade if necessary versus stop loss. I'm not a big fan of stop loss. I think of the word stop loss as, here's when I want to stop my losses by adjusting the trade. So it's still the word stop loss, however you want. I just know that my stop loss, it used to be when I first started trading, where I can close it, and so many investors think of stop loss as only closing it. Stop loss doesn't mean close out the trade. Stop loss means stop your losses. Well, could you stop your losses by adjusting the trade as well? Yeah. That's how we view things. So I view things as a student, and literally, like an engineer, or do I view things like an investor?
So in your spreads, you trade mostly then credit spreads?
I do mostly credit spreads. Sometimes I'll do a debit spread, but the only time I choose a debit spread is if I really think it's going to go up. As an example, go back to CSX. Now, could you pull the chart back up to CSX for us, please? So if I think something's really going to go up, I might start with a debit spread, which means that if I'm back looking at CSX, and I just pull up a chart.
And you would do that because you still have the flexibility to adjust as opposed to buying a call.
Correct. Now, only if I thought it was going to go up, I do a debit spread and go buy. So let's say I bought the 44 calls and I sold the 45 calls, correct? Because I thought it was going to go above 40. If it goes above 45, I keep whatever profit. So let's say it cost me 60 cents to do the trade on a $1 spread, so I have a potential of 40-cent profit, correct? So the only time I would do a debit spread is if I thought I was really going to be right but wasn't positive. So as long as that stock goes just a little above 45, I make a profit. But if it really just takes off and just takes off, I can now buy back the $45 call and now what I own is the 44. So whatever costs me to buy back the 45, I'm already making on the 44 if I take intrinsic value. The only time I do the debit spreads if I really thought there was a good possibility there was going to be a massive move in my direction, but it wasn't completely positive. Then I would use debit spread. Because then the higher it goes, the more profit I tend to make.
How wide do you make those spreads? Do you have a choice of 1 or 2 strikes?
How wide do you make the spread? Most of mine, if I have $1 strike prices, most of them are two-point spreads. No other reason. I'm just comfortable making a 2-point spread. All right. So
how do I get a chart?
Quotes, flex charts. It'll take a second to load and it comes back up. So if I thought I had a really good choice of really making a massive move, I'll just use a debit spread. I just found out that most times I use debit spreads usually don't work out in my favor. Credit spreads almost always do. Don't make as much, but still 40%. If you're going to make 40% of your money, that's still pretty good cash. You know, but if you could do a debit spread and make even more, 100%, if it really starts to really go your direction, that's even better. So if I saw a nice trend like this, and I was thinking of a debit spread, if I was going to do a debit spread here, it would probably be if I could do it as a diagonal, which means if I could buy the October, if it had an October strike price. So this might not be that cycle just yet. But if I could buy the October 40, right now it's at 40, if I could buy the October 40, let's say the October 39 calls, and I could sell the September 41 calls, then I would choose something like that. Well, here's CSX, so it's at 45. So if I could buy the October 44 calls and sell the September 45 calls and still come out with a profit, then I would do it. And the reason I would do that is say, well, but you know, Mike, you're paying extra by buying the extra time. Yes, remember, you can also sell that extra time if you don't use it. So when you're done with trading, you can still sell that extra time and raise that extra cash. Okay, so let's go back now to some covered calls. Can you just all tab back to the PowerPoint for me, please? So these are our investing rules, adjusting stop losses. Okay, those are our adjusting stop. Purpose of a stop loss is to close out a trade to protect your account. Mostly used for buy and hold. Professionals don't do this. They don't close out a trade. Professionals learn to adapt. You don't learn to crash your car if you're wrong. You learn to turn. You learn to use the brakes, the steering wheel. You learn to adapt. That's what professionals do. Investors who are brand new learn to stop loss here's the reason for this. When you teach somebody education in the stock market, the SEC pays a lot of attention to what you do. Because they want to make sure you're not a charlatan and taking people's cash. They want to make sure that you're doing something correct. So if you can tell people that here's how you manage your funds, and hey, if you're wrong, here's where you better put your stop losses. So you're not trying to tell people, hey, you're going to be overnight millionaires and it's a get-rich-quick scheme, but you can show people how to protect their cash at the same time. Stop loss. SEC doesn't get quite as upset if you teach this. But if you're trying to teach people how to adapt and change a trade, the only way you could ever teach this is if you were good at it. Because if you teach this and you're not good at it, all you're doing is helping people lose more of their cash. Now be honest with me, how many people do you really know that are actually good investors that you've actually seen their personal portfolio? Not just what they tell you, but you've seen their personal portfolio. Wow. So why wouldn't somebody, if they were actually very good at what they do, show you their personal portfolio? Think about that. You have nothing to hide. I put up my live trades every single week and show my confirmation slips on each trade. I don't just say it, I show my confirmation slips. Huh. So why wouldn't the average investor that's trying to teach you do the same thing? So if they try to teach you how to adapt and they don't really understand it, all they're doing is maybe helping you lose even more money than you would if you used a stop loss. So the SEC doesn't get mad if you stop loss. But they might get mad if you teach this and you teach people how to lose more money because they don't know how to do this. The average investor doesn't make money.